Hey guys, my name is Maya Parker. I am the owner of this YouTube channel. If you find this video useful, definitely consider subscribing. The bull case for this company, Sprouts Farmers Market, ticker symbol SFM, is super duper simple. In their investor presentation, they've guided low double-digit earnings growth, as you can see right here, which I pulled from their investor presentation. Don't believe me? Go to the phalanx. You should be in there anyways. Sorry, that's my phone. This is the thing. The analysts still think that they have better estimates than what the management is predicting. And it's why over the last lots of quarters that they've been wrong consistently by more than 40%, I believe, for almost every single quarter. And yet, still again, they want to predict that this company is going to be growing at 7.05%, which obviously is going to be wrong, just like they were wrong the other times. And this is just horrible. Well, not horrible for investors, but horrible for the ones that are predicting it right now. Because if you predict it with those estimates, then you're going to believe and you're going to be led to that the company is trading at fair value, which is not. It's not extremely undervalued. It's not going to easily 3, 5, 6, 7x, but it's a good bit undervalued, and it can easily 2x. So that is the bull case right there. The analysts have it wrong, in my opinion, and it's pretty easy to tell that they have it wrong. I mean, look at their earnings history. The surprises have, like I said, consistently been above 40%, and as of very late, it's almost 50%. So, anyways, and if we actually look at the estimates with what they have, which is for the next 5 years per annum to be 7.05%, we grow that at 40%. I mean, we add 1 plus 40%. I mean, you multiply that times 1 plus 40%, you get 9.87, which is about 10%. And lately, they've been actually beating by 50%. So let's multiply 7.05 times 1 plus 50%. So we're going to do that, and I know you can't see it on the screen right now, but that is okay. You get 10.5%, which is probably more in line with where they're going to grow, anywhere from 10 to probably 11%. And as you can see, the past 5 years, they've grown 11.41%. So we also need to keep in mind that COVID and all that stuff, but still, the point is that they're still trying to predict these things, and they're wrong, obviously. So let's go back to the beginning. I just had to show you right there, really get you intrigued. I love this company. I'm invested. I'm already up on it, not by a lot, not more than 20%. If you're up 20%, doesn't mean you're right or wrong on investment. It just probably means that you probably more likely are, but still. So we're going to talk about Sprouts Farmers Market, the facts and why I invested. This is Intriguing Investment Research with Maya. If you find this video intriguing so far, make sure to like, comment, subscribe, join the Discord, and follow me on Twitter. So obviously, the market valuation has been going down for about several years now, and it just hasn't gone up. And so now we want to know, why is the market valuation going down? What is the underlying fundamentals looking like? Is it growing? Is the balance sheet of quality? Is it managed well? Do I find meaning in this company? Is there a nice margin of safety for whatever this problem seems to be, which is reflected by the democratic market over the past years? It's been public, or is it just like the market being extremely emotional, Mrs. Market being extremely emotional? So first we want to see is we go to Seeking Alpha, and we see they have short interest of about 15%. So it seems like not only do they not believe in the story, they are willing to bet heavily that this company is going to be it's going to fail. And don't let me remind you of the GME craze. So they have a PE forward ratio of about 14.05. And then I go to the article to see what like the bullish people and the bears are saying. So we see, first, the most common word we see is Sprouts Farmers Market, a variation of the company's name or ticker symbol, something like that. And then the second most common word that we see is margins, margin. And as of late, the articles even all have been about margins. So obviously, this is why they're low multiples. It's because of margin compression or the fear of it. So that's obviously why it's like that. Andrew Latender is a fellow YouTuber. He invests in a lot of the same companies I do. He's an amazing investor. Anyways, he explained it perfectly in his latest video, which is, he said, historically, the S&P 500 has grown earnings anywhere from 6 to 10% per year and has traded anywhere anywhere from a 15 to 20 price to earnings ratio. By the way, check out this channel on his check out his YouTube channel and join my Discord to get in the know before others. I mentioned this on my Discord and I linked his video. It's an amazing video. I will also have it linked in the description of this video. He's an amazing YouTuber, way more experienced than me. He's way more experienced than me. I can't even lie. He's an amazing investor. I admire him. So Sprouts Farmers Market Inc. So we're starting with meaning. Can you even understand the company? Should be pretty relatively easy to understand. So Sprouts Farmers Market offers fresh, natural, and organic food products in the United States. It operates through healthy grocery stores segment. Through the healthy grocery stores segment, the company offers perishable product categories and of course non-perishable product categories, which they break it down a little bit more in their 10K filing, which they filed on February 25th. And it's also founded in 2002. It's headquartered in Phoenix, Arizona. It's operated 362 stores as of January 3rd, and it's been in less than 25 states, so like 23 states, which means they have lots of room for expansion. It's like it's like the $10 rule. If you can make $10 doing something, do it again, and keep expanding. They can do the same thing. They can repeat, they can produce more stores and keep expanding, and we're going to talk about that a little bit later. So I'm happy that's in the United States, so we can price it, so we can understand how to price it, because there's usually more fear where you're investing outside markets like in China or something like that, especially as of late. So their beta, which is basically how volatile the company is lower than 1, which gets me extremely excited. Even though this is trading data, not underlying fundamentals, it gets me excited. Because if you ever read the book 100 Baggers by Christopher Mayer, he talks about how great stocks often offer extensive periods during which to buy them. I think it was on page 38. Don't quote me on that, but I found it in the book 100 Baggers. It's in my notes when I read the book. So also, make sure to follow this YouTuber New Money. He has an amazing YouTube channel. He talked about Monish Prabhai, whatever. He's the author of the book Dondo Investor. He talked about his latest interview, which was about a month ago, so it's kind of late, it's kind of new. But anyways, he gave the analogy of you want as temporary fire as you can get for a cheap price, which basically means a high margin of safety. You're willing to buy a ticket as long as it's not a big fire and you're having a high margin of safety. With this company, I feel like you're getting that. With Sprouts Farmers Market, I feel like you're getting that. So follow his YouTube channel. Insiders do not have a meaningful stake, which sucks. They own less than 10%, not anywhere from 10 or even 20%, not even 5%, not even 1%. I mean, not even a half of a percent, which sucks. And that was a red flag. But after reading the book Good to Great, which I read not very recently, like 3 months ago. Anyways, they talked about how when companies are transitioning from good to great, basically a turnaround play, you would think there would be a good correlation between insider ownership or ownership breakdown and things like that, but it really wasn't, according to him. So anyways, that gets me a little bit less worried, because I do feel like they're going to be turning around Sprouts Farmers Market for the better. Jack Sinclair, which is their new CEO, which I think is a very good CEO. He was a former Walmart executive and a former 99 cents only CEO, so that gets me very intrigued. So their price to book ratio is 3.49, below 4 is good. Price to tangible book seems like they have a lot of intangible assets, so that sucks. The price to cash flow is below 10, which is amazing, at 6.24. The market cap, enterprise value, obviously they have a lot of debt, which if you dive into the liabilities and stuff, you see most of the liabilities and stuff is the leases, of course. The P ratio is 10.74. PEG ratio, don't believe that. I don't know if it's totally true. I don't really check it for Seeking Alpha, so don't look at that. And I think it's higher than 1, so it's not like it's below 1. Price to sales, 0.48, so less than 1 time sales, less than half time sales by buying this company right now. The gross profit margin is above 30%, and it has continued to grow, I believe, but you may catch me off guard because I don't really remember if it will continue to grow, but that's one of my checklist things, so if I'm investing into it, which I am, it probably has that. So I know it's above 30%, and I think I'm almost pretty sure it's continuing to grow at a pretty good pace. And gross profit margin is a great reflection of the value that the company provides to shareholders. And also another great reflection is their NPS score, which is amazing, by the way. It's in the investor presentation if you want to check it out. The return on assets is above 5% at 8.85%, and you probably want to look at more the average, the 5-year, 10-year or so average. That's way more important, because especially with years like COVID, you have some outliers and things of those sorts. shorts, you need to make sure you're looking at averages. They're way more important in my opinion. Return on equity is 39.29%, above 15%, more than double 15%. That shows me this management is very effective. Look at their average. It still seems like the management is extremely effective. The net margin, remember the type of industry this company operates in. It's why you need to understand meaning. Because if you see these profitabilities in other type of companies, it may bring a red flag. But this industry, that's pretty good. Especially their EBIT margin compared to, I think it was either Kroger or Grocery Outlet. It's higher than that by a good amount. I think it was 2% or so. Revenue growth above 10% and growing, which is amazing. And remember, we're paying less than half times sales for this company at 0.48 or 47. Don't quote me on that. I already showed you previously in the slide what it actually was. So the gross profit is $2.39 billion, which is amazing. It's around the market cap today, I think, which I think the market cap today is around $3 billion or whatever. Total cash $169.7 million. But I showed you in the other slide what the market cap and enterprise value was. So yeah. Current ratio is less than 1. Quick ratio is less than 1. Keep this in mind, the type of industry this company is operating in. Debt to free cash flow less than 1, which is great. Long-term debt only $255 million compared to their total debt of about $1.5 billion, which is good. Net operating cash flow $494 million. I don't know why I didn't put red and put in red free cash flow, which is $406 million, which is good. Remember, compare that to the market cap. That's amazing. The revenue, as you can see, has continued to expand for the better, which is amazing. The gross margin, yeah, like I said, it has continued to grow, continually growing above 30%. For the most part for the last couple of years, 2018 and beyond. So operating margin continue to grow. It's doing pretty good. Above 5% is great. So net income continue to grow. Earnings per share continue to grow. By the way, they've been doing a great amount of share buyback, which is amazing. You know, value is determined by supply as much as it's determined by demand, supply and demand. So with shares, the supply going less is always better. You only need a little bit less demand. You need like less demand for the company to rise. It's like you're sitting on shares and you're getting paid to sit on shares, basically, because they're buying back shares. So that really brings the value up. It's hard to explain. There's plenty of YouTube videos on it, so check it out there. But it's a really good thing. Just keep that in mind. Most companies are diluting shareholders. They're getting less piece of the pie. Hyperchange or Galley has an amazing video on that. I think in his playlist, Investing 101 or Stocks 101. Book value per share is growing. Operating cash flow growing. Cap spending, it has been growing, but lately, actually from like 2016, 2017 and less, it's actually kind of been declining, which is good. More efficient. Free cash flow increasing. Free cash flow per share increasing. I think they almost more than double EPS and free cash flow per share as of late. And working capital actually going down, which sucks. So the same thing with the key ratios. They all look really amazing. There's no concern. You can pause it right here, or you can go to Morningstar yourself to see this. Return on invested capital, return on equity, the return on assets. Out of those, return on equity being the most important, in my opinion. As you can see, it's continually been growing more than 15%. It hasn't had less than 15% since 2014 or since 2013. So that's really good. You can expect for sure growth of return on equity 50% plus moving forward on and on. So that's always amazing to see. And also, 2019, yeah, they had that one bad year where return on invested capital was less than 10%, but all the other years since, once again, 2013, 2014, they've never had less than 10% return on invested capital. As far as management effectiveness, the management here is very effective, which is great. I would give 100 out of 100 score for management effectiveness. Price to earnings, as you can see, this company is extremely undervalued, even compared to your average metrics, which is amazing. Also compared to the S&P 500, which I wouldn't compare it to because this type of industry is not the prettiest industry, and the S&P 500 is consistent of some of the most prettiest companies in the world. As far as balance sheet goes, financial statements, just the best of the best breed. But as far as the best companies and best investment, two very different things. This is probably one of the best investments I've seen over the last couple months, and it's why I'm sharing it with you today. The pay ratio, 1.5. I don't know if that's true, but it seems better, or it seems more true than 0.11. I don't think it's that undervalued. If you don't know, companies with the pay ratio below 1 usually reverse for the most part above that eventually. So for price to earnings ratio below 15, payback in years, basically means the payback time, which amazing book by Phil Town. I think it's called Payback Time, or Payback Time with, a couple other words in front of it or in the back of it. It's less than 10 years. Less than 6 years is excellent. Less than 10 years is great. It's always amazing to see that. So the same story for the other financial ratios, but as you can see with these financial ratios compared to the average S&P 500 company, or average in the S&P 500, you can see this company looks extremely undervalued. Now, I would say that since 2018 to now, it seems like is when it's really been undervalued, but from 2013 or so, since 2017, or those years behind 2018, is more when it was undervalued and when it was going down because, say, the metrics such as price to earnings ratio, price to book ratio, price to sales, price to cash flow were a little bit too high for this type of company. Now the margin of safety is very intriguing. It has been very intriguing for the last couple of years for where we are now. Plus, there's less uncertainty with the CEO, etc. So, also, like I said, well, we already went over this slide. I did that one of these slides, some of the first slides, so we don't have to look into that. But an amazing article by another fellow, not YouTuber, but like social media person, is by Alan, which primarily seems to run Cruising Altitude, which is an amazing podcast, YouTube channel, newsletter, or Substack article thing. They also have a Twitter page, amazing. Definitely go follow them. They really talk about it, and they even say if Warren Buffett were born in 2000, he would be reading Cruising Altitude, which I say I can totally back that up. It's an amazing book. I mean, not amazing book, sorry. They're amazing people. They have some of the same investments, which really is just Sprouts Farmers Market. And Chit Chat Money they had on there, they have the same investments as me, the ones that they had the same as me, I think, were Dropbox and Sprouts Farmers Market. And they run a fund called, I don't remember off the back of my head, but it's amazing fun. So for more research on the company, visit bamsec.com, where they organize the various financial filings very well. Also, if I had to sum up the bull thesis in one tweet, this is what I'd say. By the way, join the Discord and follow me on Twitter as Early Bird Gets Warm. And on those platforms, I am able to update you way more and way faster. The links will be in the description. So this is what I would say in one tweet. A beloved consumer brand represented by a high NPS score, trading at about 7 times free cash flow, which probably is a little bit more now since I made this presentation a while back, with a significant share buyback program in place, not going bankrupt anytime soon, and growing their online presence, represented by 340% year-over-year e-commerce growth, to piggyback off of Alan, which is the person with that thing who runs Cruising Altitude, with another person, which I don't know the other person's name, but Alan is who I follow. So anyways, this company seems very intriguing. I'm very intrigued. This is my intriguing investment research on the company. If you found this research to be intriguing in any way, shape, or form, make sure to subscribe and stay tuned for my next couple of videos. Thanks so much for watching. And by the way, I'm invested, full disclaimer in the description. Oh, and also do not forget about the useful tools linked in the description. As you can see, Hypercharts right here has some great visuals with companies, as well as I have links in the description to some other useful tools such as ArcWatcher and Stockpile, amongst others.